Exercise 15 looks at the concept of comprehensive income. And this is really a new concept for us because you wouldn't have seen this in your lower level accounting courses. But it's a common financial statement for most companies. In the narrative, it gives us a lot of information, and it's that we could set up for an income statement. So I've gone ahead and listed out sales, less cost of goods sold, gross profit, less selling and administrative expenses gives us an income, net income. So a very basic income statement. The other additional piece of information, though, had to do with this unrealized holding gain. That can go in here. That's considered a comprehensive income item, and I'll talk about it here in just a minute. So let's go ahead and write it down here. So unrealized holding gain. And again, that's going to be net of tax. Try to squeeze that in here. So we have an unrealized holding gain net of tax, and the dollar amounts, I've got this wrong, don't I? This should be $130,000. Just now notice that. Okay, so let's change net income to $130,000, and the unrealized holding gain is $18,000. Sorry about that. It'll be the same down here. This needs to be $130,000. Okay, so net income is $130,000. We've got this unrealized holding gain. Well, what is that really? Well, let's kind of look at, go back up here and kind of talk about our basic accounting equation, assets equal liabilities plus stockholders' equity. One thing that can create this holding gain is when we buy investments. So if we buy stocks and bonds of other companies, if our corporation does this, that'll be an asset. So I don't know why I put the equal sign there. I didn't need to. But under assets, we would have this investment. Okay, now that investment is initially recorded at cost. But at the end of the year, what would really be helpful if we really reported it to investors and creditors at market value. They would find that a lot more interesting, right? Or a lot more helpful to their decisions. So in some cases, when we get to the chapter in intermediate on investments, we're going to see at times the FASB has a rule that we're going to increase or decrease the value of investments. Either if the market value's gone up, we'll increase it. If it's gone down, we'll decrease it. So, we need to make a journal entry for the change here. So, an increase or decrease to market value. So we're going to change the value to market. So we've got investments at cost, and then we're either going to increase that or decrease it so we can report the investment account at market value. Well, if we do that, we've got to have something over here, right, on the other side of the financial statement, of the balance sheet to balance out. Normally, if let's say that it went up, that there was a gain, because that's what happened here. We held on to the investment, creating a gain, so it's a holding gain. The other thing is this idea of unrealized. Recall in accounting, the word realize means cash, that we sell it. So if we have an unrealized gain, that's because we haven't sold it yet for cash. So that's where the word unrealized. We haven't cashed it in yet, and we're holding the investment. So that's why this term, unrealized holding gain, what that all means. Okay, well, we need to do something over here, where the FASB debated this issue, and they didn't want companies to report this gain on their income statement. The reasoning was, well, they haven't really sold the investment, so we don't want to report the gains or losses over here. They poo-pooed that idea. Said, no, we don't want the gains and losses to go there. Well, if they don't go there, then they don't get close to retained earnings, right? So if we had reported the gains and losses here, those would get close to retained earnings, and so this gain or loss would be in the retained earnings account. So then the FASB sort of pulled out a magic wand and created a new stockholders' equity account. And that's the account called, this account down here, Accumulated Other Comprehensive Income. I'm just going to abbreviate it, Accumulated Other Comprehensive Income. So now we have this new account that we haven't seen before, Accumulated Other Comprehensive Income, and that account will be, debited if the market value goes down, right, like a loss, and it'll be increased for these unrealized holding gains. Okay, so that's how this whole idea of meeting then comprehensive income. So we still report net income, as always, but if we have these unusual transactions that the FASB has determined, it's really an economic gain or loss, but we don't want to run it through the income statement, so we just kind of push it and create, this account on the balance sheet to make everything balance. So these kind of weird things or unusual sort of things are going to go in this comprehensive income section. All right, so that kind of explains why we have comprehensive income in addition to just net income. Now, there's two ways of reporting comprehensive income. One is that we can combine it with the income statement. So we could do net income and then factor in these unrealized holding gains and losses to arrive at comprehensive income. The second approach is in B. We have two financial statements. We would have our standalone income statement, but we would also have a comprehensive income statement. So if we do that, net income will flow from the income statement to this comprehensive income statement. And then we'll show the unrealized holding gain or loss. In this case, it's a gain, isn't it? Of $18,000. And we get the same. Bottom line is we get the same thing, $148,000, whether you do it this way or that way. But as an accountant, you have an option, whatever you want to do. The other thing I want to add into this conversation, because I thought the textbook was rather weak on this area, I want you to see, when stockholders' equity gets reported, what it's going to look like. Getting towards the bottom of this board that I write on, it gets more hard to do that. Okay, so the common things, we have a contributed capital like the common stock account and retained earnings. You're familiar with that. But I wanted you just to see there is this additional account, accumulated other comprehensive income. So let's take the numbers from above. We said net income was $130,000. That would, that's going to go to retained earnings. I'm just going to make this, and by the way, these beginning balances are not in the narrative. I just made these beginning balances up. But I am going to take the $130,000 of net income and include it in my retained earnings here. Let's pretend that they also had dividends of $8,000, just to make this a very comprehensive illustration. So let's say they had dividends of $8,000. And then we have this unrealized holding gain. I don't know why I put loss there, but let's change that. So the unrealized holding gain is $18,000. That goes in this accumulated other comprehensive income over here. And then let's also, just to give common stock something, let's say that they sold $10,000 of common stock. Just to put something in there. Okay, so if we do that then, common stock will have an ending balance of $30,000. Retained earnings will have a balance of, I think that's going to be $222,000. And then accumulated other comprehensive income will have a balance of $68,000, for a total of something like $500,000 if my arithmetic is right here. But this is just adding up 30 plus 222 plus 68. Anyhow, but that gives you an idea then of what the total stockholders' equity is going to look like and how this accumulated other comprehensive income account fits into that. Okay, in this recording we're going to look at problem 6. It might be easier for you if you'll just open it up in your textbook or if you've printed it out from Wiley Plus. So here we have a retained earnings statement and it's full of errors. And the goal for us is to go through and figure out what items here should be included and what should not be included on the income statement. The retained earnings statement. So we have our retained earnings at the beginning of the year. We have a gain on the sale of investments. That is not something that should be directly reported on the retained earnings statement. That actually should go in the body of the income statement. That's just an ordinary gain. Net income, yeah, that's true. That should go on the retained earnings statement. Here we have a refund on litigation related to the year 2011. This actually is correct. Related to the year 2011 net of tax. So the refund actually is just kind of a gain or loss, and again, that should go on the income statement. We might want to report it as an unusual gain, not an extraordinary gain, down at the bottom of the income statement, but it might be considered unusual and it'll go up in the body of the income statement. Okay, and then this one, recognition of income earned in 2013, but omitted from the income statement in that year, net of tax. This is a prior period adjustment. All right, that's an error correction, and this is correct. That should go on the retained earnings statement. So we have two things that were added that should not be reported directly on in the retained earnings statement. This gain, which is just an ordinary gain, and then this refund, it's also a gain. It might be considered unusual, but it's not unusual and infrequent, so that's not considered an extraordinary item. And by the way, your textbook usually will tell you whether something's extraordinary because there's so much judgment involved in determining whether something's extraordinary. Usually I found in this book, the authors just tell you whether it's extraordinary. So they're saying this is not extraordinary because they're not telling us. Going on down, deduct a loss on discontinued operations. Well, discontinued operations get reported on the income statement. Writing off goodwill, again, that's a loss. That depends. It might be ordinary or it might be a little unusual, but it's not extraordinary by any means. So, but again, that loss will go on the income statement. Cumulative effect on the income of prior years from changing from LIFO to FIFO, that's a change in accounting principle. So that goes on retained earnings. So that's correct. So that's a change in accounting principle, and that should go here on the retained earnings statement. And then also the cash dividend. So let's see, we're going to add in net income, this prior period adjustment. We'll subtract this change in accounting principle, and also should subtract the cash dividend. Okay, so let's go. I'm going to pull up so you can kind of see then. What should this actually look like? Well, I could pull it up. My screen is not wanting to be very helpful here. Here we go. Oh, wrong thing. There we go. Okay, so the final retained earnings statement is going to have the beginning. We've got the two adjustments, right? The prior period adjustment, the correction of the error, and also the change in accounting principle. So we show those, restate or adjust our beginning retained earnings. So here's our beginning. Add in net income, subtract dividends, and we have our ending retained earnings. Okay, so that's problem 6. The other thing I wanted to bring to your attention on this video, case 6, I couldn't actually assign this in Wiley Plus, or I would have, because it's really more of an essay. But I encourage you, I do have it in Wiley Plus in the practice assignment. So you can see it there in the practice assignment. But here are the solutions to it as well. But it's an excellent assignment because it's going to give you discontinued operations, prior period adjustments, extraordinary items, change in accounting principles, change in estimate, and you have to recognize, what it is, where, what is it? So recognize it here in this column, and where you're going to report that at. So that's a good little assignment. So I encourage you, even though I wasn't able to formally assign it for points, I encourage you to work case 6. And again, that's in the practice assignment on Wiley Plus, or you can just look at your textbook, it's there, and here's the solution to it.